Happy Monday, everybody. Another beautiful day in Las Vegas. Another day in paradise, like my husband likes to say. And I do agree. So what's going on? We have good news. We have 39 days of inventory. We keep inching up there, which is great, because people realize they have equity and they're going to sell. And we're going to talk today a little bit about the mortgage. Maybe, let's see here, just a second. Let me put this on. Okay, yeah. I was asking Be Live why my YouTube went away, because YouTube says I'm allowed to do it on here. So who knows, but we'll figure that out. Every time these platforms make a change, you know what happens? They fix something and then something else doesn't work. So it goes. We listed 147 homes this just listed. That's fantastic. 45 of those were 485 and under, which gives us 1,124 available homes, 485,000 and under, which is the median. And that's 30% of the market of the listed homes, which is 3,694, because we're comparing single family. So of the 3,694, 30% are 485 and under, which probably attributes to all these closings, 153 closings. So we're closing a lot of homes. I suspect we're going to increase. Right now we're selling 109 homes a day. Of course, by the middle of June, in a week or so, we'll know that number. But look at last June. Oh my goodness, we were selling 203 homes a day, everybody. How are you doing that? That was amazing. But they were $386,000 back then too. So we're going to talk about that difference. And yes. Okay. $1 million homes, almost 5.5 a day. And they represent about 16% of the market of the available homes. There's 783 available $1 million homes. I did my $1 million video today. And if you want to look at it, they're all on Agent Formula in Facebook or on YouTube. So those are getting posted to YouTube and to Agent Formula on Facebook, facebook.com/Agent Formula. So hopefully you can go over and take a look at those and see. I don't think I've improved too much yet. I know it's always last minute with me. Just wanted to mention up here, I have Friday, June 3rd. Those were the closings as of Friday, because Monday, of course, there's none. So what else is going on here? We're still selling to investors, so that hasn't changed. But the factor is that that we want to talk about today is the days of inventory, which is 39. And that is really something, everybody. That gives people more options and less hectic offers and things like that. So let's look at a couple things today, because I want to talk about mortgages today. So let's see. One of the things I talked about last week was, yes, mortgages have gone up, but so have salaries. In the professional and business services, salaries have gone up 17% since 2019. And so when you look at, what the mortgages were, what the home prices were in 2017, in May, they were $250,000. So I need my Jimmy here. Let's see, if you 250,000 times 1.17. So that's not a huge increase. That means it's 17% of 250,000 is about 30 grand. So not a big increase there per year, though. So what does that convert into as far as you being able to afford a home? And I think that's what we need to dig down. And people are still buying homes. So hopefully this will help you understand why we're not crashing and burning, like they say. And then let's look at this, the weekly mortgage trend. I want to talk about mortgages today just a bit. We did have David Snyder on the other day, I think it was Friday, telling us the sky is not falling, and that FHA is coming out with new mortgage programs that will target the lower income people. So that's going to help tremendously. And also the ARMs are back. Today's national mortgage rate say that the average now for a 30-year fix is 5.45. And that's an increase of 0.21% from a week ago. So if you're looking to refinance, this might not be the time because there's an increase there, but that's okay unless you want to refinance into a 15-year. And maybe you do. If you've got enough equity, you might want to do that. I think that's a consideration for some people, especially if you bought last year. You might want to consider that and get your mortgage paid off faster. That's what that does, as we know. And then let's look here. All right, so what happened? So what I did was I did a $385,000 mortgage at today's rate, not last year's rate, but at today's rate versus $485 at today's rate. And you can see it's significantly different. It's almost $400, $370 difference per month. So that's a pretty big increase. So if they want the mortgage to be 1561, which would be if the rates were what they are today, if they were a year ago, kind of putting a little different twist on this, they would buy less home. So that's the dilemma people have. Do we buy less home, or do we buy the mortgage rate down, which you can do with the points. As you can see now, there's points here on these rates that I showed, and there are points on both to make it equal. So you can buy a mortgage down with points, but we're coming off a tumultuous 2 years of growth in our housing market. I mean, it has just been phenomenal growth, and now we're facing a tumultuous year of mortgage market normalization. So it's true to say that turmoil and mortgage outlooks are strange bedfellows, but it's true. And interest rates are rising. Affordability is a challenge, and geopolitical conflicts impact global supply markets. They definitely do. So it's only natural that the market players might be skittish over what direction housing will trend. And I had some conversations with some agents over the weekend, and they're like, oh my gosh, how can I get people off the dime? Though in the coming months, you'll read headlines on a housing bubble or maybe even a looming crash, but cooler heads have to prevail. That's why knowing the signs and interpreting them can provide invaluable direction for your clients and your business. And that's why I played that video on Friday with David Snyder, and David Stevens, excuse me, because he had some really great points about, the mortgage industry. So mortgage companies are not going to go out of business. They will figure this out, as they always have. And what's critical is that what is moving the market. Runaway headlines that predict housing doom shouldn't be what dictates your business or your client's next move. After all, the media would be remiss not to be apprehensive in the current market environment. And we know the stock market's not doing so hot either. So I think that impacts what people want to do with their money as well, of course. The 401ks are now the 101ks, as I heard somebody say. So behind these negative headlines is the hot housing market that has contributed to some all-time high housing prices across the U.S. Throw in rising rates and you get this ensuing panic. But how can prices be sustained when a buyer's buying power is stretched so thin? Well, the recent bias is driving negative housing headlines, and you know this. And so it's imperative that you learn how to counteract and paint the true picture. The sky is not falling. First, it helps to understand why press headlines and your clients might quickly interpret today's housing trends as fatal. Regency Recency bias is a psychological phenomena when you give more importance to recent events than taking into consideration the bigger picture. And it's the main culprit as to why so many people are executing a housing crash. The housing market has only experienced a crash, listen to this, once in 70 years. That's a fantastic track record that should speak to the resilience of the housing market. I'll repeat it, once in 70 years, we've had a housing crash. Here's the problem. What we all remember is the housing crash of 2008 to 2009. And because of its recency, that event is what resonates with people today. So you don't think that the majority of the housing industry, housing has stood the test of economic trials. And here's how the recency bias works in housing, okay? Because we experienced a crash in the not so distant past, and it was brutal, especially in Las Vegas. We were the #1 foreclosure capital in the world. What we remember is the brutality of it. We can convince ourselves that it will happen again, despite history telling us that it likely won't. Why? Because it happened. And so you're worried that it could happen again. So here's how the data helps you interpret the trends. So listen carefully. So here's where you, the real estate professional, can set yourself apart from the negative headlines driving uncertainty in the market today. Knowing where we're standing in terms of the housing industry and the trends that will prevent an imminent crash can be determined through data. So recently, mortgage rates have been a primary driver of the negative headlines that just serve to incite panic over an imminent housing crash. The narrative is that mortgage rates are now at a 3-year high. So housing affordability will go down. People might panic and people will buy fewer homes. There'll be less demand for homes, and that would be one of the big reasons there may be a housing crash. Well, no document has ever correlated rising interest rates with falling house prices. So in reality, mortgage rates have little correlation to home prices. The data shows us that rates have no impact on prices in the last 40 years. Now, you got to listen to the data. I know you're all out there seeing, maybe you see a different picture, but the data speaks for itself. Historical data shows that house prices have continuously gone up, irrespective, which is not really a good word, gone up regardless is a better word, of where interest rates are. Housing prices have continuously gone up, right? And that's because mortgage rates are cyclical. They go up, they go down. And surprisingly, home prices are not. They continue to rise, except for one fatal crash in the past 70 years. So is there an imminent wave of foreclosures? That's another question. Well, another culprit behind the negative housing headlines is the so-called imminent wave of foreclosures. That will come as the number of people in the COVID-19 forbearance exists. In 2006, a flood of foreclosures flooding the market did trigger a dramatic drop in home prices. But today, the reality is vastly different, everybody. In 2021, the record increase in home prices helped homeowners build equity to roughly $2.1 trillion, the most significant annual increase in equity ever. Data shows homebuyers since 1954, 7 years after I was born, built equity for decades. And those who did not build equity purchased between 2003 and 2007. Sound familiar? That means in the last 70 years, only 4 years, people who had purchased a home lost equity, and it took them about 6 to 7 years to recover. Which other asset class has the same kind of history? Listen to that. That's why they say that, real estate is the best hedge against inflation, because nobody has the ability to resound like real estate does. We have to have a place to live. And another misconception, let's go here for a second, is that people believe that equity builds that equity builds only for those without mortgages. That's not true. That is not true. You can build equity in your home as long as what you owe is worth less than what your asset is worth. And I don't know of anybody who doesn't fall in that category right now. If you bought your home in January and it's now May, you've gained $50,000 in equity. History has taught us that for the better part of the US housing market, home prices keep building, and the data shows that at this time, listen to this, less than 2% of the whole United States is underwater. Less than 2%. So we're not, if only 2% are underwater, they're not going to foreclose. 98% are not going to foreclose. And you're always going to have some foreclosures for whatever reason. So when you're talking to your clients, two critical data points highlight that a crash isn't imminent. So a data point that explains the resiliency of the housing market, the number of households forming versus the number of homes constructed, right? So a data point that explains the resiliency of the housing market, the number of households forming versus the number of homes constructed. Data shows that before 2013, fewer households were forming and more construction was happening. So we had a surplus of homes. That was 2013, before 2013. So since then, home builders have been so terrified that one of these days demand will go down and they'll have to constantly look to keep their construction low, which COVID only worsened because of supply chain issues, right? Prices went up, they couldn't get supplies. You know the story. So in 2021, we had a shortfall of about 5.1 million homes in the United States. We need 5.1 million homes in the United States. That's how many people want to buy homes, and we have a shortfall. That's according to NAR. And this is the gap between how much we need and how much we are building. From 2015 to 2021, the average household the household formation was about 1.5 million, and 889,000 homes were built. So listen to this again. From 2020, if I can say it, from 2015 to 2021, that's 6 years, the average household formation was about 1.5 million, and only 889,000 homes were built. So even if the building pace were to pick up by 2 times, it would take 7 years to close the existing gap. Now, you need to start building your business for the future of housing. State of mind. Be enthusiastic about your industry, not fearful. Nothing good comes from a fearful state of mind. There's a seismic shift happening in the United States housing, and it will reshape how we conduct business. And listen to this. There will be 7 million new homeowners in the next decade, everybody. And that's a 9% increase from the last decade. This is fantastic news. And look, we're in Vegas. People are moving here. Our salaries are going up. We have jobs. We live in a beautiful place. No hurricanes, no floods. Occasionally a little flood, but you know what I'm saying? Not like, the East Coast. That's why all the East Coast is moving here. My friend Barbara told me that. Hey, everybody from the East is moving to the West. Thank you, Barbara. So even more startling is that 100% of new home ownership growth will come from people of color. The number of white homeowners will decline by 1.8 million. That's something. That's from the U.S. Census Bureau. One of the most significant demographic shifts that has happened under our nose was that we saw an increase in single female household formations. So in 1981, I owned a home at that time. I was single. I did own a home. 11% of all homeowners were single females. I was in that demographic, and that was pretty significant. Today, single females make up 19%. That's almost double-digit growth, almost. The rise has been pretty substantial. And that will continue to grow given that one of the final battlegrounds that have kept single women from forming households has been the wage disparity. Men making more money than women in the same job. But that is going away. Even what the males earn versus the females. PEW research, that's some demographic company, shows that females now make as much as males in 22 of the biggest metro areas. That's fantastic. I'm sure it's that way in Vegas. These changes are a significant shift in the housing industry because historically, when we think about home ownership, the old white male is the image that comes to mind. Well, how do we prepare for that shift? One straightforward thing is to have a team that looks like the client community. And at Insta Mortgage, if you look at it, 70% of our people are people of color, 50% are female. It gets displayed in the kind of loans we do because over 60% of our loans are to minorities. Making changes is not just good for community, it's good for us as business owners as well. Now, I know may sound like a sensitive topic, but the statistics, you go to fill out a form and it wants to know your ethnicity. It wants to know, are you Caucasian? Are you Chinese? Are you Hispanic? I mean, they want to know. This is why, so that they can aggregate all that information into data and use it in artificial intelligence to predict the future. The ability to provide predictability and transparency is a feature that will set you, the mortgage industry, and everyone else apart from the rest. So, I don't know what else to say except that you have got to be able, to tell the story. You've got to be able to tell your story. And interest rates go up, interest rates go down. We'll have a little correction. We've already seen some correction, so we'll see it. The $1 million homes haven't changed. We're still selling 5.5 of those or more, $1 million or more a day. So we shall see. We shall see. So let me hide this. Stop talking about that for a second. And I love this quote by Franklin. Everybody thought that he said a penny saved is a penny earned. Well, he really didn't say that, everybody. What he said was, he actually said, a penny saved is 2 cents clear. So you need to save your money. The market's it's slowing down. You can tell we're not selling as many homes as we did last year. They were flying off the shelf last year like pancakes because of the pandemic. But if you look back into history, we're doing good. We're on par with what we were doing. And I did have that chart, I think. No, that's not the chart. I don't know. I have so many charts sometimes. Let's see. Let's put this down. So save your money. Save your money. The market will shift a little bit. Interest rates will go down. Then interest rates will go up. Now the arms are back, right? We showed you that in the beginning, the slides where the arms are. And they're 5-year arms. So let's see if I have that here. Put Ben Franklin down again. Let me put me down again. No, this isn't the slide with the arms, but the arms are back. The 2.54 arm. I mean, that's a 5 year. So in 5 years, do you think the market's going to change back to being more normal? I think so. So I think that it's not a bad idea to get a 5-year arm. Wages are going up. People are moving here. It's a beautiful place to live, and we have inventory now. So things are going to normalize. The sky is not going to fall. I know I probably say that too much, but don't panic and try to tell the story. Try to be able to capture these statistics that I told you and tell your story so that when people say, I don't know what to do right now, historically, there's been one crash in 70 years. Historically, prices go up in real estate. Historically, interest rates go up and down. There's no way to predict them. So I love you all. I want you to know that Jimmy Daig and I are doing a class today. and it's on contracts, and it's disclosures. Oh my gosh, this class is so amazing because we break down the disclosures and what they mean. And if you don't disclose certain things, how you could get in trouble, and you don't want to be in trouble. And Jimmy is always helping you stay relevant with what's going on in today's world. And these disclosures are getting more and more important as I think the number of attorneys is growing. I don't know. But anyway, you've got to dot your I's and cross your T's and know exactly what to tell people based on the houses that they want. We sell houses. We talk about homes. We talk about properties. We don't talk about people, but we do help our people, and we give them all these places they can go to find relevant information. Jimmy has done a fantastic job. There's no class like this out there. I'll tell you that. Anyway, I love you all. The class is from 10 to 1. Let's see, what time is it? It is 9:26. You can still sign up. You can sign up. The class starts at 10. And if you're walking in, that's fine. 8400 West Sahara, just walk in. Costs $20. And we'll take cash or credit card or check. We trust you all. And you can Zoom. You can Zoom. So they'll send you the Zoom link. Check your spam if you don't if you don't get it right away when you sign up, because that's where a lot of these go. Anyway, I love you all. Have a great day. It's a beautiful life, and save your money. A penny saved is a penny earned. And even though he didn't say it, I love it. We didn't come this far to only come this far.